Well, good morning, folks, and happy Friday. It's November 1st, and it starts all over again. I hope everyone had a really nice Halloween. We have a subdivision here. We're in Florida. It's a really nice, quiet subdivision. So my wife took our 6-year-old out for the neighborhood. Had a really nice time yesterday, dressed up in funny clothes. I love Halloween. I love this whole, to me, this is the whole time change and the period between now and the end of the year to me, it's the best period of the year. Everybody's different, but I love this time of year. Now, let's get into the market. Today's big report that's going to come out before you see this, actually, is the employment numbers. And I want you to see something interesting here. The range, if I can ever get this page to work, the range is really, really high. The range is between 50,000 and 155,000, that's a really big range. Consensus is 90,000. I honestly don't know what to make of this. I wouldn't really focus on the consensus. I would go with I wouldn't go with the range, I would go with the consensus. The consensus is the most important part here. If we're better than expected, if we're better than the consensus, then expect employment to be on par with expectations. That's what the Fed looks at, all right? Everybody's focused on the consensus, but this range is really wide. I never see it really this wide. It's all over the place. So S&P 500 still trading near all-time highs, but it doesn't look like there's any major catalyst. And with the small caps, let me show you the small caps. That's 2,000 smaller stocks. They're already giving up the ghost, if you will. They never made all-time highs or even close to that if you look at the long period. This is all-time highs last year. This is China. This is because of China. It looks like we're going to come down. The RSI is overbought, and it looks like we're going to come back down to the oversold territory, and that's going to put a lot of pressure on the overall stock market. That's not healthy for the S&P 500. Moreover, earnings have been so-so, but here's what you need to know. Exxon's a huge company. It has a lot of market cap in the Dow and the New York Stock Exchange. If you look at Chevron, it's trading below the 50-day and the 200-day moving average. It's not doing really well. It's coming out with earnings today. Same thing with Exxon. These companies, Chevron and Exxon, I kid you not, they have really, really large market cap, and they're both trading below the 200-day and the 50-day moving average, which is not positive. Moreover, the entire energy sector, this is all the energy stocks in the S&P 500, not doing that great either. So I believe the small caps and the energy stocks are going to be a major catalyst for the next few sessions in pulling this market lower. Now let me show you something else that's completely in line with what I'm telling you right now. If you look at the VIX index, this is the volatility index of the S&P 500. Take a look at the lows here. Since January 2018, now when markets are complacent near all-time highs, this goes lower. Let me change the settings for you. Line chart, here we go. Easier to read. Notice every time we go around 11, 12-ish, it starts moving up. That means volatility. When it moves up, volatility is rising. This gauges the at-the-money S&P options on the S&P 500. So as S&P 500 volatility increases, as it swells up, these increase in value. And right now we're near the lows, and S&Ps are near the highs. So as the S&Ps goes down to the 50-day moving average, you're going to see volatility begin picking up tremendously and move back towards 20. So right now, because of energy sector, and I don't think jobless claims are going to be that instrumental in lifting this market higher, because the Fed already told us they're going to lower rates, and they're going to lower rates again. So it doesn't look that great. It doesn't look all that bullish for the short term. Long term, I think markets are going to do great. I think China and US are going to work things out. I think there's going to be a lot of progress, but not yet. And I believe because of that, we're going to see the S&P 500 gently move back to the 50-day moving average, giving us some amazing opportunities for buys. But right now, it's time to be defensive. And right now, as I've been telling you guys for the last several sessions, it's a good time to be in the bond market. Bonds, excuse all these drawings here. We've been showing bonds during the session, but notice bonds have been coming up. They're tethering at the 50-day moving average. If the S&P 500 breaks the 50-day moving average on the way down, bonds will rally. So I think bonds are a good defensive asset to be in. I'm not seeing a lot of upside in the S&P in the short term. I hope you guys have a good weekend. Keep your eye on the job report. I'll revisit you next week with a whole slew of earnings starting next week. Oh yeah, we also have Seagate earnings today. That's one stock I'm really liking right now. So I'm liking Seagate. It's bucking the trend, but I would wait for a little pullback because it has a correlation to the S&P of about 70%. So if the S&P goes down, so will Seagate, and it's overbought. Wait for a pullback to the 50-day, and then I think you're going to have a winner. Have a great weekend, guys. If you're enjoying this, send me an email, support@marketgeeks.com, and like this channel. Talk soon. Bye.